In this video we are going to talk about the magic of compounding dividends. So before starting this video, please like this video and subscribe to our channel for future updates. The majority of investors are familiar with a few basic rules. Purchase cheaply and sell high. Make sure you're not putting all your eggs in one basket. Don't try to time the market or take on more risk than you can comfortably handle. However, much fewer individuals are aware of compounding's magic, and how it may increase your profits tremendously. Compounding, in simple terms, means that if you continually invest smaller sums of money over time and let them to grow, your long-term return may be better than if you merely invest one large sum and hope for the best. Reinvesting dividends is the best-kept investment secret for getting the most out of compounding. Dividends are payments made to shareholders who own stock in a company on a regular basis, typically once or twice a year. Investors who own bonds receive a coupon. While some investors use the money as ordinary income, others choose to reinvest it by purchasing further shares or bonds in the same company. Let's take a look at how compounding can help you. If you had invested £1,000 on August 31, 1998, in a fund that follows all of the firms in the UK's FTSE All-Share Index and taken the dividends as income, your investment would have grown to £1,682.30 by August 31, 2018. If you had reinvested the dividends, that same £1,000 would now be worth £3,268.10, nearly doubling in value over the same time period. Dividends have traditionally assisted investors in gaining consistent income and further growth from their investment portfolios over time. However, as investors seek alternatives to low-yielding fixed-income products such as government and investment-grade bonds, equity income strategies have gained traction in recent years. We examine the historical returns of these methods in this paper, as well as why we feel they should be included in investment portfolios. The power of dividends and the effect of compounding dividends have historically been a significant contributor to long-term overall returns. According to our calculations, if an investor had invested $100 in the S&P 500 index in 2001 and reinvested all dividends, the investment would now be worth more than $350.30. Exhibit 1. The Power of Dividends and Compounding Growth of $100, February 2001 – July 2020. A more granular perspective can be gained by looking at average stock performance over a longer period of time. Dividends were a major component to total return until the late 1980s, when they were de-emphasized. Dividends were largely the only saving grace throughout the lost decade of the 2000s. Following the collapse of the dot-com boom, investors shifted their focus back to dividends. Exhibit 2. S&P 500 Total Return, Dividends versus Capital Appreciation. According to industry data, corporations that pay dividends not only have higher returns than non-payers, but also have reduced volatility. While some investors may associate dividend payers with stodgy businesses with slow growth, dividend payers can be found in a wide range of sectors and industries. Dividends can compel management teams to be more fiscally responsible, as they may otherwise be tempted to utilize capital on potentially dilutive purchases. Exhibit 3. Average annual return and volatility by dividend policy for stocks in the S&P 500 index period, March 31, 1972 to December 31, 2019. Many income investors used to believe that the best place to invest for stability was in the Treasury or corporate bond markets. Treasury bonds can be a safe haven in times of crisis, but their yields have fallen dramatically following more than 3 decades of bull market. Treasury yields in the United States are near all-time lows, thanks to global central banks reducing interest rates to near zero levels and injecting trillions of dollars into the system. Only a few times has the dividend yield on the S&P 500 index been higher than the yield on 10-year U.S. Treasury notes. Having stated that, the current situation is one of those cases. Exhibit 4. Equity income versus bond yield for the 20-year period ending July 31, 2020. Corporate bonds with investment-grade ratings aren't always appealing. Bonds issued by some of the better-rated firms have rates that are even lower than those offered by U.S. Treasury bonds. Microsoft, for example, has a bond maturing in 2027 with a yield of only 79 basis points, as of July 31, 2020. Exhibit 5. Yield on Microsoft corporate bond, 3.3% February 6, 2027, BPS, for 3-year period ending July 31, 2020. During the COVID-19 sell-off, why did dividend strategies underperform? The S&P 500 has seen 3 bear markets in the last 20 years, each with a drop of more than 30%. The 2001 dot-com tech crash, the 2008 financial crisis, and the current COVID-19 related worldwide sell-off are all examples of this. During the sell-offs of 2001 and 2008, dividend strategies beat the overall market. During the current financial crisis, however, most dividend indices have underperformed. The S&P 500 Dividend Aristocrats Index, for example, has underperformed the larger S&P 500 index by about 6% year to far. Exhibit 6. Cumulative excess return of dividend indices against S&P 500 index. There are a few reasons why dividend strategies have underperformed so far in this crisis. To begin with, most dividend-paying strategies are underweight in the IT sector. During the bull market, the technology sector was a good performer, and it has so far outperformed during the present down market. Big tech businesses, in our judgment, are likely to emerge uninjured, if not stronger than before, as a result of work from home, play from home, and deliver to home tailwinds. When compared to the S&P 500, most dividend indexes are notably underweight in the technology sector, as seen in the table, Exhibit 7, lowering returns. Exhibit 7. Average sector exposure of dividend indices relative to S&P 5000 31st of December, 1999 30th of April, 2020. Second, the present sell-off is most likely fueled by the pandemic's simultaneous shocks and the collapse of the oil market, which appears to have led to huge energy businesses seeking for methods to save money. Third, current underperformance of dividend strategies is being driven by anomalous underperformance of the traditionally defensive utilities sector. Dividend cuts are on the rise. Finally, we argue that the relative drop of dividend schemes indicates that investors are expecting severe dividend cuts or entire payout suspensions, as opposed to the last 2 recessions. While central banks' fast efforts appear to have helped stabilize financial markets, the global economy's sharp decline has put significant strain on businesses' cash flows. As a result, we're starting to see some corporations either stop paying dividends altogether or lower them. While the number of companies cutting dividends is still low, Morgan Stanley data shows that the number of companies canceling dividends entirely is now greater than in 2008. Consumer services, hotels, restaurants, transportation, airlines and travel, oil and gas, and capital goods appear to have accounted for the majority of dividend suspensions and cuts. Exhibit 8. Rising dividend cuts. Anchor Capital's dividend income strategy. While dividends can provide a significant amount of an investor's return, investing in firms with extremely large yields may not be the greatest approach. The reason for this is twofold. First, companies that expand their dividends faster than their earnings tend to reach a point where the payouts are no longer supported by earnings, which investors can see. Second, in their effort to pay bigger dividends, these corporations may overlook prospects for expansion. Companies that pay reliable dividends, on the other hand, tend to exceed their benchmark over time, according to Anchor. Dividend payments, we believe, compel corporations to make more prudent financial decisions. We place a premium on dividend income from companies that can afford to not only pay but also expand their dividends at least in pace with profits growth. In the long run, we expect the companies in our portfolio will grow their earnings faster than the GDP. This strategy can be seen in all of Anchor's methods. Anchor's dividend income strategy, which invests solely in dividend-paying equities, takes this concept to its logical conclusion. One of the numerous ways Anchor strives to give our clients with downside protection during moments of market volatility while also generating competitive long-term returns is through our preference for dividend-paying stocks. Anchor's dividend income strategy is unique in that it invests heavily in small and mid-cap firms. We are confident in our ability to choose small and mid-cap stocks, and we have a track record of success spanning more than 3 decades. Furthermore, rather than focusing on just the highest dividend-paying sectors, Anchor's dividend strategy considers dividend-paying equities across sectors. This can help to lower the portfolio's overall risk. More than 3 decades. Furthermore, Anchor's dividend strategy selects dividend-paying stocks across sectors rather than focusing on just the highest dividend-paying sectors. This can help reduce the overall risk in the portfolio. Exhibit 9. Anchor Dividend Income Strategy Investment Process. Exhibit 10. Anchor Dividend Income Portfolio Characteristics as of July 31, 2020. Summary. Dividends, as we've shown, may be a significant part of total return over time, with dividend-paying stocks outperforming non-dividend-paying companies in the long run. In this low-interest rate climate, dividend schemes can be extremely appealing. Nonetheless, not all dividend-paying stocks are created equal. Our focus on discovering high-quality firms that can expand dividends over time, we believe, is a compelling investment opportunity. What are your thoughts on our video? What do you think about the power of compounding and how can you use it to generate money? Please let us know in the comment section below. If you enjoyed this video and would like to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.